Welcome to my 8th Professor Chat. In our last chat, we discussed midterm planning as the critical bridge between the short-term and your long-term strategic framework. We're now in the crucial phase of implementation that occurs through short-term planning. For our purposes, I want to break this into two types of planning. I call the first operational planning. It's the activities people do in the organization to drive results. The second is financial, to guide expenditures through budgeting and measuring performance through financial outcomes. In a previous chat, we talked about organization with roles and responsibilities, processes, and so forth to execute the running of your business. The emphasis was on energizing the organization to fulfill the value proposition, leading ultimately to sales. And within those activities, there will be natural goals and expectations. Some activities will be more profound on the financial results than others. Shell had a consultant named Larry Selden who introduced me to the concept of value drivers. Others like McKinsey have developed this kind of analysis to improve financial performance and increase company value. The broad aspects are rather simple and straightforward. You can increase revenue by increasing price and/or volume. You can reduce costs by improving processes, reducing procurement costs, increasing productivity, and so forth. You can improve capital deployment by reducing accounts receivable, better investment decisions, reducing inventories, and so forth. But what Selden brought to the table for me was to look deeply into specific activities that make a big difference. For example, higher call center volume may be a real driver in increasing sales volume. That is a measurable value driver. Each company will have its own unique value drivers. Like critical success factors for the midterm, value drivers are a major factor for improving short-term performance. Identify the most profound value drivers for your company, which are likely to be only a handful. Now, value drivers may involve offsets. Increasing the number of sales representatives will have an increased cost, yet may produce much greater sales to offset those costs. Now, for those value driver areas that require organizational effort to implement, they become projects for the coming year. Those projects that the leadership team wants to follow and review are called key action items. Key action items drive the business forward, providing momentum and growth in the company. They're like rocks in the EOS for those familiar with that framework. Now, as indicated, pursuing an impactful value driver can become a project and certainly a key action item. Similarly, your critical success factors will also have projects that would fall into key action items, as they are the linkage from the midterm to the short term. Not every operational project will rise to a key action item, but should be properly managed. Now, there are many different areas that may warrant a project, such as specific marketing plans to expand your customer base. Another common area for projects is process improvement plans to redesign work activities. Even people plans become projects. Projects may require just one person, such as a people plan of you hiring a CFO to raise capital for new equipment. Many other projects will require a team. These projects should have an identified person responsible for successful completion, along with any other individuals required that will lead the team accountability as well. Now, beyond projects, operational planning looks at what it takes to run the business, from big items like a building lease to administrative supplies. This short-term operational planning will lead to identifying costs and revenue estimates for the coming year. At this point, it is what I would term a bottom-up process. That leads us to the financial planning phase. At your current stage of progress, I am sure you are familiar with annual financial budgeting. Let's all move quickly through this process. Now, each business area identifies the potential costs for the coming year, and they break out as applicable: the cost of goods sold and manufacturing costs, if you're a product offering, and likewise the respective responsible players for marketing and sales. They estimate revenues and marketing sales costs. Then develop other overhead costs. It's helpful to have supporting detail on the costs and the revenues. Obviously, this builds ultimately an income statement that should have more summarized categories in the budget plan. And pick out the key target areas such as revenue, overhead, the cost of manufacturing if that's applicable, and so forth, which will be used in performance reporting process. More about that later. Now, you haven't arrived at the final key targets yet. There needs to be a top-down process on evaluating the overall plan. Can we afford it? Are the costs too high? Are the revenues too low? What will we need to do to increase them? In my opinion, you need to be sure the targets are high performance. You can't become a high performance company with low performance goals. Now, if they are high performance, no problem. Otherwise, you should think about adding stretch to the goal. There needs to be other financial targets. I find that not everyone at the takeoff stage thinks through their cash flow, which is absolutely key to sustainability and investment growth. The three components of cash flow are cash from operations, cash flow from investing, and cash flow from financing. Cash flow from operations comes from your net income, plus adding back any non-cash items such as depreciation and amortization. Cash flow from investing is often negative if you have major outlays for new equipment, or say increases in working capital such as higher inventories and accounts receivable. Cash flow from financing, as you expect, is generally new long-term debt or a new capital raise. I think cash flow is so important you should develop a cash flow target for the coming year. You should also begin to get a handle on the value of your business. EBITDA is the most widely used measure, as you might already know. It represents earnings before interest, tax, depreciation, and amortization. It's a measure of your cash generation. I think you should also have a target for EBITDA too. Now, putting it all together, you should have produced an income statement, a balance sheet, and cash flow statement for the coming year. As we have outlined, several items on this pro forma represent targets for the year, and someone in the organization should be accountable for explaining the results during the performance review sessions that we'll be speaking about shortly. But before I go there, I want to discuss several other concepts. First, if you are making large investments, such as equipment, buildings, particularly acquisitions, and so forth, you may want to jump into the bigger company's process of calculating discounted cash flows. The overall cash flows are discounted by your cost of capital, like 10%, to see if it meets your desired return. Now, I'm not going to explain that in detail here, but you may want to look at my blog, Really Understanding Financials, a Key to Small Business Success. Secondly, I do think contribution margin can be very helpful for companies with significant unit volume. It gets into fixed and variable costs, which enable you to calculate the number of units required to break even. Break-even analysis can be hugely helpful in understanding what's needed to be successful. Third, we talked about putting a financial stake in the ground during your midterm planning. And you should develop pro forma income, balance, and cash flow statements that can achieve that goal. Obviously, these forecasts don't have to be as detailed. They could go out 3 and perhaps 5 years, but I don't recommend any longer than that, as the estimates are generally not of much value when you get beyond that. In Shell, we did 10-year forecasts, but we had long life assets in oil wells and refineries and chemical plants. But there are too many uncertainties for those forecasts to have much validity. Now, these pro forma financial forecasts should be included as part of an ongoing business plan. Fourth, if you have identified projects in building your operational plans and they have an associated cost and benefit, adding or deleting them becomes an effective way of adjusting the budget. You can think of them as modules. It becomes a prioritization process. This approach is much more effective than the willy-nilly slashing budget line items. Fifth, I really recommend you develop a balanced scorecard for measuring your results. This involves identifying key performance indicators for the different aspects of the business. Now, I'm using the term key performance indicators here broadly to represent anything on your scorecard. I would start with critical success factors, with the key action items identified to fulfill that factor. Develop a key performance indicator based on the actions being undertaken and the associated timeframes. Are the projects on course? Put down a green. If there are some issues, put a yellow. And if there's significant issues, put a red. The next gauge comes from your operations and your value drivers. Create a key performance indicator that measures the progress on the value driver. Include only those value drivers that are most important to driving revenues or reducing costs. Now, the third gauge involves your financial performance. Include your key financial targets, such as revenue, maybe EBITDA, cash flow, and so forth. I continue to recommend that you color these in green, yellow, and red, and comparing target to actual. Lastly, include any other gauges that you feel are important in assessing your business performance. You might have one on competition, maybe employee feedback, and so forth. I would suggest being selective to have no more than 10 or perhaps 12 KPIs. Now, this overall color chart of your scorecard can give you a real sense of how the business is doing overall. So, what do you do about it? This leads to the fourth phase of performance feedback. Like the other phases of planning, strategic assessment, strategy development, and implementation, this step is crucial in the execution process. I recommend a meeting at least quarterly with your leadership team entitled Performance Review. A title like this represents the company is interested in performance. If you have a lot of variability in the company's costs and revenues, then monthly would be more appropriate. Now, the review sessions are best face-to-face, but it can be done over Zoom if you have done the balanced scorecard, and the process is simplified. So focus on those areas with a yellow or red score. You should have predetermined who is accountable for each KPI on the scorecard. So you let that person speak to the issues. Now, the Army invented a process called after-action reviews. That was way back in the 1970s, but it is still widely used by many corporations. The intent is to take an objective view of what happened, what can be learned, and what do we do about it. Foremost, it is not a blame game. Certainly people can disagree, and that is a helpful part of the process. But if the issue involves a project managed by an individual not on the leadership team, invite them in for the discussion. This strengthens accountability throughout the organization. Now, as mentioned before, project leaders should also report out when there are milestones that are occurring. This project review session would normally be with just the overall accountable person on the leadership team for other than key action items. Others should attend if it has a high impact on their activity. Now, relative to the financial target KPIs, another part of the process should involve developing an evergreen forecast. This is not for changing the targets. They remain as developed and agreed in the budgeting process. The targets are used in your balanced scorecard assessment. The evergreen forecast purpose is to make adjustments going forward, particularly on costs and investments. Too often, departments can just keep on spending, thinking they have the budgetary authority, even though revenues have not met plan. Before you know it, your company can be in a cash crunch. Now, the evergreen budget establishes a new level of expenditure authority. And if the revenues are substantially exceeding forecasts, this can open room for new activities and expenditures in the evergreen budget. We'll celebrate successes, and you can get creative on having some fun out of all this. Now, the quarterly reviews are really important in making adjustments with key action items, budget authority, and other performance issues related to your yearly game plan. The year-end performance review should be more intense as they are an important marker in the company's progress. How did we do? Now, the learning should feed into a meeting with the employees during the first quarter of the year. My suggestion is that this annual employee meeting review the strategic framework, the midterm critical success factors, and year-end results from the scorecard, and outline the coming year plans along with any other discussion items. Well, get your people involved and engaged. The planning process keeps cycling. So once you have completed your strategic framework, which is not yearly, then the next stage is your yearly midterm planning. And that becomes input into your annual planning cycle that we have just discussed. Well, this completes my 8th Professor Chat of the 8th series on trying to help you as a takeoff company. And I really do hope these have been beneficial for you.